Hi, I'm Victor. In this video, I'm going to compare two corporate bonds. One is very low risk and the other is very high risk. One pays a very low rate of return and the other pays a very high rate of return. It's interesting to look at corporate bonds these days. I've liked corporate bonds for many years. I've invested in them for more than 28 years. And really, like 20 years ago, bonds were a really attractive investment option. You can balance your portfolio. They provided an 8 to 10% rate of return, which was great. And you could also own, shares of stocks. A couple of years ago, interest rates were so low that bonds were really unattractive. You were making just a couple percent rate of return. And meanwhile, the stock market was just on a tear. So in 2019, 2020, 2021, I was mostly invested in stocks, and that really worked out well. But as we reached the end of 2021, beginning of 2022, really stocks began or stopped being such a great return asset. This year, the S&P index is down 16% as an example. The NASDAQ is worse. So stocks have really taken a big hit. Meanwhile, interest rates have really gone up. So the rate of return on bonds is really picked up. That makes bonds more attractive to me, where I can, again, get an 8, 10, 12% rate of return on average and really have a nice, more stable way of having a good return on a portion of my overall, savings and wealth. So in this video, I hope you find it interesting that I'm comparing a very low risk bond issued out by Berkshire Hathaway, and then another one from Rite that Rite is in a little bit of trouble, but I think I've looked at their financials and feel like they have a path that they can take to get themselves out of the bad financial condition they've been, and they're in a good space. Rite is a pharmacy for the most part, a retailer, and a retailer of consumer staples. Now, 2022, consumer staples, that's a good place to be. Pharmacies, good place to be. So I think the industry I really like, and the company has a good path going forward. They had a very good earnings call not too long ago, about a month ago. So that was also encouraging. I own both of these corporate bonds. So all my videos, these are assets that I own and invest. But I'm not recommending either to anyone. I'm not a professional advisor. If you need one, I hope you can find a good one. And I hope you weigh your investment decisions carefully. Everyone's situation is a little different. Some people are saving for retirement. Some people have a need for their capital back. That's 5 years from now, or 15 or 25. Weigh your decisions carefully, and good luck investing. Now, let me tell you more about these two corporate bonds. All right, I'll get started with the Berkshire Hathaway corporate bond. Berkshire Hathaway is really a established company, to say the least. Warren Buffett, Charlie Munger are the ones behind Berkshire Hathaway. They have a market capitalization above 600 billion. They own a collection of companies that they invest in. So it's a very safe company to invest in. And I believe a very safe bond to buy from Berkshire Hathaway. This bond has about a 10-year, term to maturity. And let me tell you a couple basics around the bond. So here's first the ID number that you would find this corporate bond. If you go through your brokerage, you can find this bond. It's very well rated by S&P and Moody's, very low risk. The term, this bond will mature March 15th, 2032. A little less than 10 years from now is when they'll return, $100 to you, and you'd be buying it for a little over $90. The current yield is 3.163. I have a different way of calculating return, and I'll take you through that in a little bit. And the Treasury benchmark is 4.5% on a 14-year term. So this bond, again, this one's kind of a set it and forget it kind of investment. Your money is going to be exposed to very little risk, and you see your rate of return. If you're willing to take on more risk, you'll be rewarded, and that's in the form of Rite Aid's corporate bond. I think Rite Aid, there's some people that believe in the company and are betting on the stock. I own CVS. I've also owned Walgreens before that. So I've been an investor in this space for quite a while, understand it to some extent. And, Rite Aid, I think is an investment, worth considering. For me, I bought the corporate bond, just looking at, the risk reward ratio. It's attractive to me. It's going to yield, as you'll see, in a little over 30%. And I think, some people fear, risk, and that kind of clouds, the whole decision process, where I take on some risk. My portfolio, for the most part, is a safe portfolio, but a bond like this can really spice things up in my portfolio. If it really works, this can really give me a good rate of return and improve the overall performance of my portfolio. If it doesn't work out and I'm sitting there at a loss, it didn't damage my portfolio a whole lot. So that diversification, in my portfolio gives me the ability to invest in a high risk bond like this. Let me give you some fundamentals on this bond. Here's the ID number. You look at for this number in usually for Fidelity, you go into fixed income and then you can search for bonds and you can get more details. This information is from Fidelity that I'm showing you. A couple other basics, very low rated. They use the term junk bond. I didn't make up the term. I get it. They call it junk bond. It's a high risk bond. Call it whatever you'd like, but that's the rating that both of these agencies provided. The term's not that long, little less than 4-year term, so not too long. And the shorter the term, the lower the risk with a bond. If you have a bond that's like got a 1-year term, not a lot of things can happen in that 1 year, so very low risk. If you have a bond that's like 25 years, a lot of things can happen in 25 years, like a pandemic, like, a lot of things to that company in that industry. So a short term, I think, limits my exposure. I like that short term. The current yield that they show is 12.52, but I'm going to show you that I actually calculate my return differently in a little bit. And then the 5-year yield is 6.6% currently. Now, looking at the rate of return that I'm expecting, I'm going to start with Berkshire Hathaway. There's two things you're going to get from a bond. You're going to get the coupon rate, which is spelled out in the bond itself. And here you're going to get a coupon rate of 2.88. That's defined in the bond. Okay, great. So every year they give you basically interest, $2.88 for every $100 you invest. In this case, it's $90 because it's sold at a discount. Since this bond is being sold at a discount, you're giving basically your brokerage or whoever's selling you the bond $90.88 to own a bond that in 10 years when it matures, they give you $100 back. So over the course of 10 years, you're going to make $9 in appreciation from $90.88 up to $100. And I have that in this row, maturity, gain, loss. So you're gaining 91 cents per year. So when I add the interest plus what you're gaining each year, I get to $3.79. Divide that by the bond price, and you get a coupon plus annual gain yield. But I also do a formula using Excel where I really calculate the annual return rate. And I do that by doing a goal seek based on the current value and the net present value of the cash flows that you're expecting. And it calculates at 4.97%. So that's my annual rate of return that I'm expecting from Berkshire Hathaway. Now taking a look at the higher risk alternative, which is Rite. And again, Rite has roughly a four, actually close to a 5-year maturity schedule. And the coupon rate that they're paying is $7.20 per $100 that you invest. But you're buying it at a big discount. $61.49 is what you would pay. But when it matures less than 5 years from now, they'll give you $100. So each year you're making, on average, $7.70 of appreciation as you get closer to that maturity and they return that $100 to you. So if I add those two numbers, I get $14.90. And that calculates at $24.23 as the coupon plus annual gain rate. But again, if I do a goal seek and take the net present value of these rates compared to the investment that you're making, you're actually getting an internal rate of return of $31%. So it's a really nice return. And again, I've analyzed Rite as a company, so I'm comfortable that they're going to exist in 5 years. Could there be some surprises, like they have to restructure their debt? Yes. Could there be some surprises that, business goes wrong for them? Potentially. Those are very real. What's also real is they work their way out of this, financial mess they're in right now, and they end up really delivering on this bond. I think there's a very good chance of that. They're in the right industry. They sell consumer staples. So it's not like they're selling something the market doesn't want. It's actually something that's, an industry that's working. My CVS stock has been doing great. CVS is a very well-run company, but the industry has a lot to do with their success right now. It's a very good industry to be in. So that's one thing that Rite has going for it. They also have, I think a good management team that's leading them through this process. They've been reducing debt. They had a very good Q1 to get the 2022 year started. So the the performance in that quarter gives me some confidence that they're working their way through the bad balance sheet they currently have. And I decided to invest in both of these bonds, but as you can imagine, the Rite investment had far more diligence and is a higher risk investment. So I really did extra homework on that side. So just a quick reminder, this is for entertainment purposes only. I like to share my experience as I'm investing in corporate bonds and stocks and so forth. I'm not recommending you buy these bonds or any security at all. I hope you found it interesting. Well, thanks for watching my video. I hope you found it interesting, and maybe you have a few ideas with regard to corporate bonds for your portfolio. I want to wish you the best of success in your investments in 2022. It is a tricky time in the market. I'm trying to expand my knowledge, and my biggest investment this year has been my time in studying the different types of investments that are out there. And as you can tell, I really have gained a lot more knowledge in corporate bonds, and have started putting capital into corporate bonds so that I could beat the S&P. It's not difficult since it's down more than 16%. If you could do me a big favor and like my video, I'd appreciate it. That way the algorithms will recommend this video to more people. And if you like the content, subscribe to my channel. I'll be producing videos just like this one on bonds. I also do a lot of stock videos, and I also review cryptocurrencies since I do own some cryptocurrencies. And last thing is, if you click the bell, you'll be notified when I create a new video. Thanks again for watching. Good luck investing in 2022.